we got a nice body of people here. Ksusha, I want to, maybe it's most fair just to introduce you and what I am to kind of start with. But really, the conversation I want to have with you is a little bit away from what your day job is, and kind of want to dive into
Yeah,
what I've titled the future of finance. But let's just give people a kicker of just, you guys, your team, and kind of what you guys do, and then I'm gonna actually start asking the hard questions after that.
sure, absolutely. So, so I'm Ksusha. I'm the co-founder and CEO of OneAM. My background is I was once upon a liberal arts major, and my parents expected me to go get a PhD in something, and I couldn't quite pick a subject, so I went to Wall Street and became a trader. Spent a while in trading and portfolio management, and worked at a hedge fund, worked in wealth management, asset management. So kind of a long career in finance, and then um, got into trade finance at a company where I met Charlotte, who had kind of walked the road of MasterCard. So she was a MasterCard alum. So, my kind of quantitative finance brain collided with her financial infrastructure brain. And we were working at a company that was doing factoring, kind of the very much old-fashioned way. And Charlotte and I started chatting and working on this and thought, you know what, there's got to be a better way to do it, both in terms of creating something that's more flexible and more business friendly, and taking advantage of all the new technology that now gives you not just business friendliness and flexibility, but also ease and speed and just a much
Yeah.
better experience. So we kept waking up at 1 a.m. for about 6 months saying, wow, we got to do this. And then we finally resigned and started this company about 2 years ago. So we're coming up on our 2 year anniversary. We're a team of about 9 people. Almost all of us are here in New York. Many of them are still in the office. So
Yeah,
good
that's
job,
great.
guys, working
Good
past
job.
5 p.m.
Yes, exactly.
Very impressive. Impressive work ethic. I'm here too. I'm just in a phone booth.
That's funny.
And yeah, we I don't know. I live in New York. I live in the city. I got 2 kids. Living the dream of
That's
entrepreneurship.
great.
Um,
Well, I mean, I'm going to just say off the bat, I think you guys have accomplished some of your initial goal, because um, the way you and I met was through actually one of my clients. And in this client's case, they have some very large corporate names that they work with. A lot of that means that they're leveraging their accounts receivable constantly. Somehow they met you through some industry contacts, and then you and I came together. And then I saw the way your technology attaches to really some basic software that are using QuickBooks and other things. It made total sense to me. And some of these like strategies and desires that I've had for agencies to grow just immediately made sense, because the qualifier that you guys have in place to get access to capital based off of assets they already have in accounts receivable was amazing, opposed to like traditional loans or lending or kind of all those predatory kind of practices that are out there. A total game changer. So mission accomplished for you guys.
Thank you. Thank you.
Yeah.
Yeah, that's been an incredible part, especially after a long time knocking about big financial institutions and these nameless, kind of anonymous places. The fact that you're actually helping very specific businesses, that's been the most amazing kind of rewarding part of this, is that you're actually helping people grow, and you actually have, form relationships with people that are doing all kinds of incredibly cool things.
So this is the thing. You and I keep using this word grow and growth and strategy, whatever. I don't think people are used to thinking about like cash liquidity as a
Hmm.
requirement for growth. I think a lot of people put all the effort into sales. So a lot of thought is, I'm going to invest in the salesperson. I'm going to grow revenue. I'm going to keep revenue growth. I'm going to find new clients. I'm going to get into new segments and sectors. And they take all this risk of taking on a new client, begging for work, which means that the client has more control of you and can, slow down payments or push things on margins.
Hmm.
And people will put a lot of pressure on themselves. They'll even take on a lot more work, and then they don't experience growth and they don't know why. So
Mhm.
that's not uncommon for people to reach out to me after 2 or 3 years and say, they're basically saying, I don't get it. I don't get why I can't get past this curtain.
Mhm.
And one of the things that when I titled this The Future of Finance, it's almost like the idea of like, we're not talking about cryptocurrency, let's say. We're talking about the ability to finance your future and
Mhm.
knowing that access to capital is so important in that moment, not just
Yeah.
revenue growth by itself.
Yeah, absolutely. So that is what we so we're industry agnostic. What we specialize in is in small businesses that have large end customers. And what you see when across industries, when you work with customers like that, is that you as a business owner, you have outflows, outflows, outflows. You have to make payroll, you have to pay for your, equipment, office space, whatever it might be. And then the revenue comes in these big lumps. And so you have lots of outflows and these occasional episodic, very large inflows. And so what happens when you do that is that it's very difficult to get stability, right? And so basically the receivables finance it's been around for thousands of years and it's the simplest thing in the world, which is just that, instead of waiting to get paid, you bring that cash flow forward, and that way you're able to match it up much better with the outflows. What
Yeah.
that creates is stability and control, which allows you to, first of all, plan much better for the future. It allows you to invest in growth more strategically, right? So let's say that, you want to expand your team, hire more people, or invest in the business somehow. Do you want to wait 6 months until that big windfall comes through and then go looking for that person? Or do you want to maybe bring them on now? Because you've already earned that revenue, right? That money is already
Right.
yours. It's just not in your bank account. And so being able to spend it in plan for those future expenditures and current expenditures better allows you to invest in your growth. And it also allows you to think about the payable side of the equation, because if you are seen as a stable business that has, constant cash flow and just a less volatile situation, then you're going to be able to attract better talent, retain better talent. You'll be able to negotiate better terms with your vendors and the
Yeah.
payable side. So that it kind of that's the part that I think people don't think about when they think about capital, which is that
No,
this
it's
money is
funny.
already yours and you're just exchanging one asset that's on your balance sheet, which is accounts receivable, for a better asset, which is cash, in exchange for a small discount.
Well, there's almost a maturity factor here too, because in a lot of people's cases, the only finance persons that they've met so far is an accountant, maybe a bookkeeper if they're lucky, and a banker, right? So then when they're in a liquidity situation, the first thing they go to is consumer credit. It
Mm-hmm.
is so common. It is very, very, very common for when I first talk to agencies that I work with or studios I work with who are in financial trouble, that they call me when they've maxed out their American Express card because it's the first easiest pace of credit you can go to at 22% interest.
Mm-hmm. Mm-hmm.
They go get a line of credit from a bank at 11 or 12% interest, and then a loan from their dad or their mom or their cousin or whatever. And then they finally say, hey, maybe there's something broken. And then to flip them to, and traditionally what I do is I work, I teach them where money comes from, how the spending should be controlled from the beginning instead of waiting
Mm-hmm.
till the end. And then what I do is develop a large cash reserve so that they basically can become their own bank. In
Mm-hmm.
in the case of asset financing or AR financing, I don't necessarily have to have all that cash on hand because accounts receivable is an asset just like cash. It's just the
Mm-hmm.
conversion of it. And very few people have ever realized or learned how to convert AR to cash. It's not something that's a common marketplace
Mm-hmm.
item. So because of that, they stick with the predatory lending. And it really is predatory lending. I mean, I think they're part of the monopoly game is to get people into consumer loans because some of the larger corporations even want you to borrow money from them to do it.
Yeah, it's I mean, yeah, consumer loans just as a rule are going to be more expensive than business loans because it's a smaller entity and it's a harder thing to go after and all of that. And then the what you also see in a lot of consumer loan products is they make it difficult for you to do the math intentionally and difficult to figure out how much does this actually cost.
Yeah.
And you see that both in the traditional world and in some of the kind of consumer fintech lending occasionally as well.
That is like the worst. They're the worst practitioners. Those, we will pay you today based off your long-term accounts receivable, but it is harmful because it's almost like you can never pay it off. I mean, what they get you on is really used to paying that regular monthly payment only on interest, never making a principal payment, fees attached to it, early payment fees, late payment fees. It's just incredible how hard it is to get rid of some of that. Um,
Yeah.
and
Yeah.
to imagine not even have to do that. Like in your case, it's like plug and play, and your AR is in a marketplace, and that marketplace will buy it. Much like, is this fair to say, like much like if I had stocks to share, if I had
Mhm.
shares of something and I wanted to sell it, I could say, hey, I have 10,000 shares of Apple and you want to buy it, and there's a marketplace, an E-Trade marketplace I can put it on. You've kind of
Mhm.
introduced that technology and accessibility.
Yeah, a little bit of the kind of creating that stability and control in the business actually requires you to separate your personal from your business, from your business, and think about those two things as two separate things. Because obviously, I mean, we're all entrepreneurs. I'm in the same boat. You take a lot of risks to start something from scratch and to leave a big place and to strike out on your own. But at a certain point, as you mature and you wanna be able to separate church and state as much as possible. Like I said, we work with a lot of different industries, and we have some clients who are in the energy business and in retail, where there's market cycles that are beyond your control. And so we have business owners who have been through cycles, and they say, last time I got the cheapest possible bank loan at my bank, they required a personal guarantee. And then when the market made a downturn, through no fault of this business owner, right?
Yeah.
It was just a recession. It was not his fault. But then, he started worrying about his family and had to, it affected his kids and his
Yeah.
family. And so now that he's recovered and returned to profitability, he said, never again. I will never give a personal guarantee. I'd rather pay a little bit more to make sure that that's
Yeah.
protected. So those are all the things that Charlotte and I kind of tried to think through, because you do see those frictions where a lot of times the financial institutions that make the loans or provide the capital, they're not really thinking about the little guy, right? And so there's things that make a big difference for the small business owner that just kind of get left out. So for instance, one of the things that we've built into our platform is that there's no contract and there's no commitment. It's literally you use it when you need to, and if you don't need it, you don't have to take it. So once you're hooked up to the portal, and let's say you have clients, you have Apple and Google. Anytime there's an Apple and Google receivable that we cite in your systems, we'll send you offers. You can accept them or not. It's up to
Yeah.
you. And so, whereas if you take out a loan, then you're committed to be making those interest payments. If you take out a term loan, you're committed to making those payments. It's happening in your business. Maybe there's a downturn. Maybe you'd rather not make that monthly payment this month, right? Or what have you. So it almost makes it harder for you to manage your cash if you
Yeah.
have a loan versus something that's more flexible.
Yeah. And I
So
love the idea
what
that it is,
clients
it's
will do is
basically an
just,
asset.
yeah, go ahead.
I think I was hesitating, but I was saying, like, what my favorite part is, like, it's an asset you already earned. Like, it's actually, you're not borrowing against the future at all. These are assets that you've collected. The client owes you the money. This is very, really, really clear. You're just leveraging that asset. And um, I don't necessarily like the term pay early, because these are not payday loans. These are not like the predatory payday loan processing. This really is like systematically being able to access something. And to some degree, you don't have to, these are not necessarily for only people in trouble. These are not like, when I get in trouble, I dip into it like my line of credit. This is something that you leverage and can leverage constantly so that you can
Mhm,
maintain a standard cash flow in your business. And as you
mhm,
said, gain stability, grow your payroll, because you can make those payroll payments, every other week like
mhm.
you're required, even though clients are paying you in different times and different processes. So you can
Yeah,
reinvest that gain back in your business, and that's where we get the growth. part of this strategy.
Yeah. When you use the term early pay, that suggests that it's somehow premature, right? Or
Yeah.
not fully cooked yet. But the reality is that if you're working for large corporates, they could pay you tomorrow. They totally
Please.
could, right?
Yes.
But they're
Yeah.
choosing to pay you in 60 days or 90 days or 120 days. So
Yeah.
there's, so that's a little bit of the mismatch and the mismatch in the balance of power that creates these long payment terms.
Yeah. Quite literally, when I got started, we would not start a project until they gave us the first 50%. We wouldn't accrue one expense until half of the payments were in our checking account, and then we would start. And these corporations at that time were paying us within 4 or 5 days of signing a contract. To think now that you start a project, you must be 30 days into it or 60 days into it before you got paid, and you might even be close to delivery, if not already delivered before you've
Yeah.
received the first half of what you've earned, let alone the second half. That obviously kind of keeps the small guy down, because if you can't capital finance that yourself, you're just saying no to projects, or more important, you can't say yes to projects because you don't know where that would come from.
Yeah, and so it just, instead of taking 12 projects a year, you have to take fewer, and so it just slows you down that way, if nothing else.
I also feel like you can be more choosy with who your vendors are or who your freelancers are, because if I'm afraid I can't pay you, but I choose the friendly ones, meaning I can say to them, hey, I'll pay you when I get paid. And the vendor or freelancer says, okay, I'll go along with that. I might not be choosing the person that's most qualified for this project. I'm just choosing a person that would say yes to those payment terms. By flipping that on your head too, you can be more selective. People that are more aggressive in requiring payments, you could say yes to them and you can do it.
Mhm.
So these are all like things that we have idealized, because again, access to AR financing it's not very common. I'm truly most excited that you're making this a common practice, because it should be very common.
It's a
We're just
it's
not
a
out there.
funny thing because it's been around for thousands of years, so it's not a new solution, but there's so many, but it was a very old, low-tech industry historically, and there are some bad actors and some factors to engage in predatory practice. So the industry has kind of a not the best reputation, even though the actual financial solution itself is totally sound and in many ways better than taking
Yeah.
on either debt or equity, actually. So that's been their kind of cool pocket that we've uncovered as we've built this, is that some of our clients are startups where they're not comparing receivables finance to the cost of debt, they're comparing to the cost of equity. And they say, oh, well, instead of banging my head against the wall, talking to VCs and trying to pitch this, I can just bootstrap using
Yeah.
receivables finance.
And it's not, I want to say this too as clear as possible. This is not a loan, right? This
Right.
is an asset that you're selling at a set
Yeah.
price. So
Yeah.
time of that, like the person who's purchasing it or the marketplace that purchases it knows what they're buying into, knows what the timing of their payment is. And I think, is this right? On OneAM, you guys there are no late fees or something like that. Like it's an
That's right.
asset they purchased.
Yeah.
They're going to get their money. They bought it
Yeah.
that way. So the
Yeah.
lending practice that you're accruing interest every day and all that kind of stuff, that's not true at all. Like this is,
Yeah.
you sold it, like you sold your car, you sold a shoe or whatever you're selling. Here's another question I often kind of come across when we talk about this. It's the cost of it. So a
Mhm.
lot of people, they don't know where to place the cost. And I think a lot of people, when they imagine AR financing, the discount. So let's explain how it works. Maybe let's explain what AR financing is in the most basic terms, but I'll do my best and then you can correct me. How's that sound?
That's good.
Here's the thing. So you have accounts receivable that has a dollar amount to it. So let's say you have a $10,000 accounts receivable. If I sell it on the marketplace, I sell it at a discount. So I might sell it for $9,900. So the person buying it's going to make $100 on that transaction in 30 days. The reason why they're doing that, we don't have to get into that, but that's what AR financing is. I sell my AR on a discount. In this scenario, that $100 gap, some people immediately think of that as a cost that removes it from their profit. So they're thinking, that's taking $100 off my profit if I sell my AR at a discount. And it's hard for them to qualify that, no, that's a cost of business. If I required you to buy, in order to do this project, buy a software that costs $100, you would put that in the $100 category, the cost of doing business, or a 3D model. I put it over there. So certain clients are giving you payment terms. You can recognize that as a cost of business with that person, and you take it from the cost category, not your profit category, and you
Mhm.
are spending a piece of that money on that discount. I think that's hard for people to conceptualize. I don't know
Mhm.
why, but I often feel like when it's finance, they think it comes from their pocket, and any other vendor cost, they take it out of a different pocket.
Yeah, you're right. It's a little bit of the cost of doing business with these very high profile large clients, right, that give you large projects. And so this is just kind of a feature of the ways to get paid by them. And so first of all, you can kind of anticipate that as you're scoping the project and putting in a bid. The other thing we've seen some clients do is, let's say that they typically can support 30-day terms, but then they suddenly have this client that insists on 90-day terms. You can figure out what the cost is of financing those receivables and just bake that into the contract. So we'll sometimes, if people haven't won the business yet, but they're pitching for it, we'll help them figure out where the sort of line is, where they're basically indifferent between getting paid in 30 days and 90 days.
I've
Um,
actually seen the reverse of that. Like Apple, they'll say, "Hey, we'll pay you in, I don't know, 60 days. But if you want it earlier, you give us a 10% discount, and we'll pay it to you sooner." And people will accept those payment terms, most
yeah,
likely because there's no other marketplace out there. But yeah, it's
yeah.
interesting. Do all, like, you're in other industries? Do all industries have that kind of hang up, or is it
It's
creative people think differently
no,
than
it's
energy people?
across a number of industries. It's more just that, first of all, large corporates, if they're publicly traded, they always have the incentive to kind of goose their financials on a quarterly basis. And so they want to have cash on their balance sheet because it makes their financials look good. That makes their stock go up. Or they might be doing M&A, and so they'd rather have the cash lying around in case there's some quick acquisition that they need to make. Now with, investments in AI and all of that, they may need more of a cash buffer so that they can borrow more in the bond market. So there's all kinds of reasons that industries or large corporates across industries are slowing down terms, slowing down terms. But then the biggest thing is just because they can, right? And so in industries where they have a lot of leverage, you'll see these payment terms get worse and worse. So in the energy industry, where there's been a ton of consolidation, everybody is working for the majors. And so payment terms are 60 days if you're lucky, but then something happens, or, oil prices go down, or quarter end, year end, or, they shut down their invoicing system and say, oh, there's a system blackout, so don't send us invoices because we're not going to pay them, right? And so you can easily go to 90 days or more. The worst terms we see are actually in automotive, where you'll see terms as long as 360 days
Oh
because
my
it's the
gosh.
big three and everybody's working for them. And so they kind of they effectively are using their small vendors to finance themselves,
That's
which
so
is
crazy. Isn't it amazing that, so kind of what you're saying is this is somewhat a result of just like monopolies. And the
yeah,
more
yeah,
consolidation
monopolies and
there is, the
oligopolies for
bigger
sure.
the
Yeah,
I feel like there's like a David and Goliath strategy that we're working on here to say, hey, you don't have to take the bully and
yeah,
let him take your lunch money. You can do something else.
yeah. Yeah, so that's, yeah, I mean, we are trying to help David. That it's actually another thing that's quite different about us is that so we arrange financing from a network of capital providers, but OneAM itself is a pure fintech. And so the way we get paid is we charge a flat fee to the capital providers. We don't charge anything to the business owners. So our incentives are very much aligned with David, because if your cost of capital is higher, we don't make more money off of that. It's a flat, we make a small percentage of the invoice face value that we charge the capital provider. And so our incentive is to find businesses the most working capital for the most reasonable price.
That's
We
awesome.
don't profit from people paying a higher cost of capital.
If there's one thing that you've learned, like no matter what, I know you even have a great financial past here. Like if there's one thing that you've learned that kind of developed the conviction of why this is the right result, right way of getting something done. You know, what is that like thing that you've learned that made you want to invest in building out this company that you're like, this is truly the right way of doing it? Everyone should get rid of those bad predatory practices.
I think that, the light bulb moment was sort of it as part of the very intensive discussions and analysis that Charlotte and I did together. I think that a lot of the insight has been a little bit of an outsider's perspective on this very old-fashioned industry that we both brought to bear. Um, so, I think that there's a lot of complexity to financing receivables, right? There's you as a capital provider, you have to think about, are they real? Are these invoices real or fraudulent? Is this, an Apple receivable or is it a Saks Fifth Avenue receivable and Saks is about to
Right.
go boom, right? All kinds of things. But I had the utmost conviction that the way to underwrite something complex is you have to use data and you have to use analytics. And that's kind of the world I came from. So, I make the joke that I worked once upon a time, I was a portfolio manager at a hedge fund and that was me. I was trading mortgage derivatives in 2008.
Wow.
So there's good
So you
character
learned the
building
hard way.
experience.
Yeah.
But, in all my time trading, I never once dialed into a Fannie Mae earnings call. I didn't care what the CFO had to say that quarter, right? I had a model that ingested data. And so I feel like that's, in every area of finance, I do think that the smart money eventually replaces the dumb money. And the smart money is that's adept at just taking data and pricing things in a flexible way. And so that was the mismatch I saw where because the capital providers weren't very sophisticated historically, the business owner ends up paying for that lack of sophistication because that lack of sophistication, first of all, shows up in a more expensive price because it's like, well, if I can't assess it, then I better bake in an extra spread for myself. And
Mhm.
it translates into friction of emails back and forth and uploading things, downloading things, PDFs, personal guarantees, right? All of those types of things. So I knew that there was a better way to do this because, I knew that there's guys out there that function differently from banks.
Yeah.
And I think that, and then we kind of had this hypothesis. And then as soon as we started onboarding clients, so many of them say, oh, you should talk to my friend, or, oh, I'm a fractional CFO. You can help me with these three other clients. And it just, that, that positive response kind of proved that we were,
Yeah.
that we were solving for a big need that has been underserved.
You're solving for a big need. There's no doubt about it. I,
Yeah.
by the way, my least favorite predatory lender out there is the SBA. I think the SBA does a disservice to so many people because it seems like it's accessible. Banks use the SBA for the financing, but the terms of it and then the SBA's ability to collect is really, really, really stressful. So there
Yeah.
should be a corporate veil. It's why you have a corporate veil. You are earning something. You should get credit for what you've earned, not just a portion. That's kind of what's kind of BS about the bank lending is you can have $200,000 in accounts receivable, and as a part of assets, they might give you credit for 100,000 of those, and therefore they
Yeah.
give you less access to your already existing assets, less control. And I think it's because they didn't do the hard work of understanding who you are. They just want to sell a product to anybody that's willing to buy their product at an interest rate. And you guys are kind of looking under the hood. You're recognizing the payment terms. You're looking at the assets for real, and you found a marketplace that's willing to support you. So that's great.
Yeah. I mean, I
And that,
think the old-fashioned rule of thumb was the smaller the business, the higher the risk. But if you're a small business that's working for these blue chip investment grade companies,
yeah,
there
where's
that's
the
no
risk?
longer the case.
Right.
That's no longer the case. You
If
deserve better.
Verizon owes you money, Verizon's is it should be on the line, not your corporation. Yeah, exactly right. That's very
Yeah.
true. Can you I asked you to bring up just the screenshot of it because I
Yeah.
we've been talking about the marketplace, but this is the breakthrough for me just to see how that maybe you can explain of like you basically are looking at someone's QuickBooks accounts receivable,
Hmm.
and then your technology allows to move those invoices onto this platform, and you can see here's the invoices and here's well you explained it, but
Yeah. So it sounds this like very abstract thing, but to kind of put it in plain English. So we have little app. we onboard you, we get you to connect your bank account and accounting, et cetera. And so we get you to share a whole bunch of business data. It takes most people 15 to 30 minutes to onboard. There might be a little bit of back and forth after that, but it's generally pretty quick. And then once you sign up and are approved on the portal, we will pull invoices for whatever your clients are. And so in this example here, Jennifer is waiting to get paid by Rivian, Tesla, and Toyota. So if she has to submit her Rivian invoices into SAP Ariba and Tesla into Coupa, and then Toyota has their own portal, or she has to submit them through email, it doesn't matter. We kind of pull whatever is eligible. And as soon as we say the invoice in your QuickBooks, and as soon as we can verify that the data ties out, we'll send you offers. So and so you can accept them or not.
I've logged into OneAM, you're plugged into my QuickBooks. I can look at
Mhm.
this marketplace and these are the offers. Don't have to take any of them.
Mhm.
But I can see what the offer is, see what the discount is, and therefore
Mhm.
know, like,
Yeah.
okay, this is
And
reasonable.
so the discount column here that is literally all you're paying. And so let's say Jennifer just wants to accept this one offer here on her $45,000 from Rivian. So $765 is all she's paying.
Well,
And if Rivian pays in 45 or 50 days, we don't charge late fees.
wait, so we skip this step just so we don't
Oh,
have confusion. The invoice total is 45,000.
yes,
What the buyer is willing to buy is 85% of it, which
that's
means
right.
15% of it is not part of what they're buying. It's your whole 15%. And you guys leave a little bit for the business owner
Hmm.
to keep so that they still collect it. So it's never 100% of that invoice being bought.
Yeah.
And
Yeah.
that 85% is worth 38,000. The discount is 750 on the or 785. So that's how that plays out. So I just want to make sure everyone know that
That's
you didn't
right.
go from
That's right.
45,000 to
Yeah.
37,000. There's an $8,000 loss. There's only
Yeah. We typically won't buy 100% of the invoice. And so that helps protect the capital provider if there is a little bit of a short payment. And it also aligns incentives because we want you to keep collecting, right? However, if you have to chase someone or send an email, do want you to continue to do whatever you're doing to make sure that you collect, because we try not to get between you and your customers.
Yeah.
So you kind
I
of
want
have
you
to
to say
keep
it one more
doing
time
what
because
you're doing, but
yeah.
the benefit of that is that we don't get into your relationships.
Yeah, I want you to say it one more time because this is another thing that people shy away from with factoring is they're afraid they sell an invoice to someone else and
Mhm.
the person they're selling to collects almost
Mhm.
like a debt collector, and that is not the practice at all. You still are the person, you
Mhm.
interact with the client, you are collecting it. When you collect it is when that percentage or that total amount discount goes to the
Yeah.
purchaser.
Yeah.
Yeah. So
Yeah. And so
that's a
that's
big change, a big difference to what you guys are doing also.
Yeah, and so that's also very different from a loan, which is just going to auto, debit on the 15th of every month or the 30th of every month, regardless of what happens. We want to make sure that first we cite that payment from your customer, and then we'll auto debit the balance that's owed to OneAM, and you keep the rest.
Yeah, that's awesome.
Yeah.
And that's really how easy it is. So I log on the platform, I look at the invoices, I choose invoices, I hit accept, and the money shows up within 24 hours. So it's not
Typically,
even like you've already
yeah.
pre-approved it so that when you sell it, it's like selling it on a
Mhm.
marketplace.
Mhm.
The buyer buys it, the money's transferred to you, so on, and it gets there. Yeah.
Yeah. And so and if you just kind of continuously sell your invoices as they come due, then you create effectively a float for your company. That's that's a cash reserve, but it's supported by the business having to dip into your personal savings or put your own personal money into, in there. So it's kind of it
Yeah.
creates a self-sustaining cushion.
That's that's truly those are the key factors that I've not ever seen in the marketplace at all that OneAM is bringing.
Well, it's
One is
been
your
yeah, it's been incredibly rewarding to sort of partner because I feel like, that's a lot of what it seems like that's a lot of what RevThink tries to do is just to help creatives with everything non-creative and just to make sure that it's not just that you're not just doing projects, but that you're actually building a business and a sustainable business. So
yeah.
it's been really, really cool to learn more about what RevThink does and to partner with you guys.
And just in the last 2 years, a portion of that you and I have been working together, but we've actually seen companies grow because of this. Like people that would have said no to projects can have said yes to projects. And some of them are government type contractors, so contracts. So there's these sequential liability clauses that they're stuck with. And to think that they are keeping up with some of the terms that they have for their vendors because of it is just really great. So it is kind of fun to get some freedom in people's finances and give them an alternative to, again, some of those predatory practices out there. It's been really, really rewarding.
Yeah, and it's I hear, so at this point, a bunch of people who said they've had to turn away business because the corporate wants 120-day terms, 180-day terms. And so what we see people either having to say no and pass on projects because they can't support the working capital gap. Or what we also see a lot is at the same time that they're pitching for the business, they're also negotiating payment terms. And so just to not be able to not have to do that, and just focus on, on the creative aspect and making sure that you're the best person for the job, having that as I think is a big benefit.
Me too. Okay, I can talk about this all day, but I'm a finance geek, so I don't think we want to burn too much more working capital of other people for their day. But Ksusha, thank you so much for joining me on this call and just exposing this entire field to me and to the team and to the community. There's so much opportunity now because we're not a victim to anyone else's predatory practices. We can kind of like earn the asset, sell it, get access to it. Truly amazing discounts. The prices that you're asking for discount are better than anything I've seen out there. I've seen people lose 5 or 10% of the value of their invoices through some of these factory areas, and this is awesome. So
yeah, it's there's a lot of businesses that try to give or there's a lot of companies that try to give businesses money. There's fintechs and there's factors, but the holy grail and what we've put tremendous effort into is just ease and flexibility and a reasonable price. And I feel like that's what no one's really accomplished yet. You can get ease and flexibility, but not a reasonable price. And you can get a reasonable price, but then you got to go to a bank branch and, promise your first burn to the SBA and stuff like that. So,
yeah. Well, also you're building a marketplace, and that's why I want to work with you guys, because I feel like the stronger the community is in making this marketplace sound, the more beneficial it is to everyone to be around. So if you're successful, this part of the industry stays successful. And the people that are in the know, kind of like in the community and know it, have a major benefit to it. So there's just win-win-win all the way around this deal. So it's so fun. It's so fun to do this with you guys.
Yes, very fun, very fun.
All right. Well, thank you very much.
Thank you so much.
Charlotte, Sebastian, the whole team, you guys are amazing. Thanks for keeping this going and doing the wonderful things you guys are doing.
Thank you.
Thanks again for the dinners. We did LA, New York, and San Francisco dinners. We're going to have to do it again.
Thank you for letting us be a part of this incredible community of people who are so dynamic and doing such cool stuff. It's like, it's just been a treat to get to know you. So congratulations. You've built something really, really special.
Yeah. Well, right back at you. You guys fit right in. I was a little worried about Sebastian if he was going to fit in. He's kind of shy and awkward.
Yeah. I have the same fears.
This is good. No, we're a very introvert heavy company, and Sebastian just balances us right out. So it's great. One of Sebastian versus eight introverts is pretty much an even match.
He was the last one to leave for every time. It was great to have him around.
Whenever you want to come to New York, please come to one of our office happy hours.
Yes.
Yes.
Free cocktails and mocktails courtesy of Industrious every Thursday.
I love it. Sign me up. I'll be there. All right, you guys. Thanks again.
I
appreciate it.
Thank you. Thanks so much, Tim.
All right.
Thank you, everyone, for joining. Take care.
Yeah,
Thanks.
Bye.